Morning, everyone. Welcome to our Phillip Securities Research Morning Call. For today, we have quite a bit of stock counter results and updates, followed by technical analysis and Singapore Weekly. So, without further ado, I'll hand over the time to Jonathan to get us started on Meta's results. Thank you.
Yeah, thanks, Zane, and good morning, everyone. So I'll just start with Meta's first quarter 2024 results. Overall, it was quite a good set of results for Meta. It beat expectations on both the top and bottom line. So if you look at first quarter revenue, it came in at 24% of our forecast, of our full year forecast, and PATMI was at 25% of our full year forecast. Typically, the first quarter is the weakest quarter of every year, especially for PATMI. So if you just extrapolate out, it quite handily beat expectations. Um, the main positives is kind of a recovery in the digital advertising industry. That's really you're seeing a lot more demand right now. There are two main factors for Meta. The first is that they have um, invested quite heavily in their AI products. So there are a lot of AI tools for new AI tools for creators to create more interesting content, which is driving more eyeballs to the platform. And secondly, they also have their generative AI based recommendation system, which is essentially right now about half of what you see is actually recommended content from Meta instead of people that you follow, for example. So this is essentially widening um, uh, the eyeballs for different type of content, driving people to look at stuff that they wouldn't necessarily be interested in potentially. And this is a big plus for advertisers because for advertisers, essentially you're getting more people from a diverse background and diverse demographic to look at your product or your advertisement. It's kind of indirectly driving up higher advertising revenue. Um, the main real negative for Meta is they did mention that they're going to be spending a bit more on their capital expenditure, especially as they especially moving forward for this year and for next year because they continue to double down on scaling their AI capabilities. So for Meta, they are also trying to build out their own silicon, so their own accelerated chips. I guess to some extent to compete with NVIDIA, but to a lesser extent so that it's a little bit more customizable to what they want. And so they're able to tweak it a little bit better compared to they just bought it from NVIDIA. Um, yeah, so they actually raised their capex guidance for this year by up by about $4 billion to roughly 40 billion US dollars. So quite significant increase in terms of uh, capex for this year. The other knock is that they are forecasting sort of a deceleration in revenue growth for this quarter that we're in right now, the second quarter of 2024. Um, Main reasons is because they are uh, over the last year or so, demand from Chinese outbound advertisers. So a lot of Chinese e-commerce companies, especially advertising on platforms like Meta and Google, trying to entice non-Chinese customers or at least customers outside of China to go to their platform and to purchase. Seemingly because I guess domestic demand is not really that strong right now. So over the last year or so, they've been pumping a lot of money into advertising, trying to attract a lot of these people. And so as we go into the second quarter, this is when the demand started to pick up from China. We are going to be lapping a little bit more of a period of stronger growth, and so naturally the year-on-year growth will come down a little bit. That being said, if you just take a look at the trailing 12 months revenue for advertising, it will continue to increase upwards. So even though growth is slowing down, it's still essentially just making uh, all-time highs, more or less. So a very very strong sign, a very good sign for Meta and for the digital advertising industry in general. In terms of valuations, we still maintain and accumulate. We'll be lower our target price slightly to 510 US dollars, mainly because we raised our capex by 10%. So that's all for Meta. I'll move on to my next counter, which is Google. Um, Similar story from Meta, digital advertising growth, um, search growth is still strong, and she was seeing a quick reacceleration in growth, a quick acceleration at least. The one thing that Alphabet or Google has over Meta is that they have their very strong cloud business, which is still its fastest growing segment. You see this chart on the left here, or this table on the left, almost 10 billion in revenue for the quarter, and growing at 28%, almost 29% per year. So very significant growth. The big pickup, it's mainly due to a customer, I guess, resumption of migration to the cloud from on-premise to off-premise, as well as Alphabet has a very attractive tools for their productivity tools for their cloud business. So this is driving a lot of customers to Alphabet as well. Um, and then the last positive is margins are continuing to expand quite significantly due to their ongoing cost efficiencies. So they laid off quite a number of their staff, and they downsized quite a bit over the end of 2022 and the beginning of 2023. And this kind of reset in terms of cost base has been very beneficial to Alphabet. I guess not just Alphabet, but also big tech as well. And so when you're looking at margins, or at least operating margins, for example, they're close to 32%, which is essentially almost pandemic highs. So they're very close to where they were, when it was basically boomtown during the pandemic, and no one could go outside and all that. So still a very compelling story for Alphabet. The main knock is similar to Meta is they guided to higher capital expenditure due to similarly, doubling down on AI. So they're building out more of their data center infrastructure as well as servers. So for Alphabet, they did guide a little bit higher. So they spent about 12 billion in capital expenditure for the first quarter. And they mentioned that they'll kind of hold this rate steady throughout the rest of this year. So essentially 12 billion for four quarters is close to 50 billion in terms of capex, um, and for next year as well. So this was significantly, not significant, but slightly higher than what we expected. Uh, and so there's kind of a negative because it kind of impacts your free cash flow and valuations. Yeah, so for Alphabet, they also initiated a new quarterly dividend of 20 cents per share. So in line with most of its, I guess, big tech peers, they started to issue the dividend as the addition to share buybacks in their capital structure. In terms of our valuations, we actually maintain accumulate, and we raised our target price to $195. Mainly because we raised our PATMI for this year by 8%, due to better cost efficiencies, offset slightly by a increase in capital expenditure by $10 billion. We raised our terminal growth rate to 4.5% from 3.5%, more or less to be in line with Meta, especially as the digital advertising industry starts to rebound. And we're starting to see a little bit, better pricing and better increments from a lot of, I guess, AI products and how AI has helped long-term growth. Yeah, so we maintain and accumulate on that. So that's all for Alphabet. I'll move on to my next counter, which is AMD. So AMD had kind of these results were slightly below expectations. I think it was significantly dragged by its gaming and embedded segments, which were down almost 50%. So for the gaming segments, it's mainly their Radeon GPUs, so GPUs in your PCs, right? As well as SoCs in the chipsets in your consoles like your PS5 and Xbox. The big reason why gaming is down quite significantly is because the console cycle is in its fifth year, and historically, I mean, every year after a new launch, it just kind of declines because no one really wants to buy a 5-year-old console. Just wait the next year or the year after for a new console to come out. And then for their embedded segments, is a lot of their chips that are required in these automobiles, and become there are more electronics in it. Even your chips in, for example, your refrigerator, even your air purifier, stuff like that. Um, so it's seeing a little bit of weakness there. But in terms of the main positive, their data center growth, which is their AI GPUs, continues to be very strong. Demand remains very strong, especially as they ramp their new MI300X GPU accelerator. So this would have been its first full quarter of sales. And their MI300 has become AMD's fastest ramping product. It reached $1 billion in less than 2 quarters. So aside from their growth, they also did raise their um, like, expectations for revenue for their GPU from 3.5 billion to 4.5 billion for 2024. So this essentially implies an additional 300 million US dollar ramp each quarter as they continue to build out their supply chain and really satisfy the significant demand in orders. So aside from their AI GPUs, their traditional server CPUs are also doing very well, gaining, I guess, market share from Intel because um, what they're saying is that their new server CPUs are more efficient in terms of performance as well as energy efficiency. And as more people, more corporates transition from on-premise to off-premise, it will also stand to benefit AMD because essentially you need a lot of the CPU compute for these traditional cloud services. Yeah, the last policy that I'll talk about is we're starting to see early signs of PC upgrading cycle. Uh, and this is good for AMD. You look at their PC revenue in this red box over here, it's up 85% year-on-year, so very significant. Last quarter was up about 60 plus, so the growth continues to accelerate. A lot of this demand is actually coming from OEMs like HP, Lenovo, and Acer. Um, that are starting to order and input more of AMD's new Ryzen 8000 series chips into their laptops and their desktops as they await, I guess, as they in anticipation for a new upgrading cycle as people kind of are looking to upgrade PCs. So it is early signs, but it's good for the overall PC industry. In terms of the outlook, um, AMD actually guided to about 5.7 billion US dollars for this upcoming quarter, which implies a slight acceleration in growth from 2% to 6%. And this, will likely be supported by continued growth in your data center as well as your PC segments. Um, yeah. In terms of our valuations, we actually upgrade AMD to a buy, but we lower our target price slightly just due to a higher, a prolonged weakness in its gaming and embedded industries segments. The reason why we upgraded is mainly because of the recent share price weakness. So it kind of dropped quite significantly, even though um, we do see that near term, the AMD is actually very well positioned to capture a lot of your data center GPU share, especially as they compete with NVIDIA. And because right now there's just so much demand for a lot of your AI GPU chips, and AMD's MI300X is actually a very good comparison to NVIDIA's, I guess, older H100 chips. Um, and so they also get to see a lot of your flow through demand from customers that maybe aren't able to get their hands on the newest NVIDIA chips. They are okay to settle for AMD's chips instead. Yeah. So we think that towards the AMD's results will actually be very backloaded towards the second half of this year, especially as they continue to ramp their GPU chips because firstly that the revenues will expand quite significantly more than it would decline. Uh, and secondly, from the margin perspective, as your new product starts to ramp, margin will continue to expand. Usually, the most capital intensive portions are the initial phases of the ramp. That's where you build in a lot of your costs, your fixed costs. Whereas as the product starts to take off, then your margins start to expand a little bit. Yeah. So we upgraded to a buy. And that's all for AMD. Now I'll hand it over to Ambrish to carry on with Microsoft. Thank you.
Thank you, Jonathan, and good morning, everyone. So moving on to Microsoft's third quarter 2024 results. Overall, the results were in line with our expectations, and its total revenue, it grew by about 17% year over year. And this was mainly led by its cloud service Azure, which grew by about 31% year over year. And this was mainly led by cloud migration. So basically, enterprises, they shifted their on-premise workloads on SAP or Oracle to cloud. And also, management highlighted that there has been strong demand for its Azure AI services. So these services, they basically help enterprises to build, develop, and integrate their generative AI solutions. So the examples basically includes development of chatbots or content for summarization of generative AI tools. And also the Microsoft, its more personal computing segment revenues, they grew by about 17% year over year. And this was mainly because of recovery in its Windows and gaming segment revenues. So Windows OEM revenue, it grew by about about 11% year over year, and management had forecasted a guidance of about sorry, to remain flat. And the upbeat, it was mainly because of the recovery in PC sales. So this revenue, Microsoft basically earns from the PC manufacturers like Dell or HP who install Windows on their on their machines or laptops. And gaming segment revenue, it grew by about 50% year over year, and this was mainly led by the acquisition of Activision Blizzard. So also it witnessed a higher engagement in the number of the players. They played for a number of additional number of hours, mainly because of the addition of popular gaming titles like Call of Duty on the Xbox, the Game Pass streaming service. And lastly, the last positive is that its margins, they continued to expand, like its operating margin. It expanded from 42% to 45%, and this was mainly because of high operating leverage. And this was mainly because this was despite the company spending its capital expenditures, like they grew by about 66% year over year to build out its cloud infrastructure. And despite this, the margins have been expanding. So moving on to the outlook, for the current quarter, it expects revenue to grow by about 14% year over year, and it would be led by the Azure, which with a stable revenue growth of about 31% year over year. Uh, Whereas the Office 365 commercial revenue is expected to grow by about 14% year over year. But in the near term, we expect the weakness in the small and medium enterprises business, mainly because of the cautious IT spending due to the macro uncertainties. And the capex capital expenditure is expected to increase sequentially, whereas the operating margins, despite this, it's expected to remain flat at about 42% year over year. And in terms of valuations, we maintain an accumulate recommendation, whereas we have raised our target price to $465 from 450, mainly because we have increased our PATMI estimates by 2%, mainly to reflect lower expenses. And overall, for Microsoft, we believe that it's well positioned to benefit from the shift of workloads from on-premise to the cloud. So moving on to PayPal. Uh, PayPal, it also had reported its first quarter results last week. So the results overall were within our expectations, with the first quarter coming in at 24% of a full year forecast. So the total revenue, it grew by about 9% year over year. And this was mainly because the payment volumes on its platforms like Braintree, Venmo, and the branded checkout, the total payment volumes, they grew by about 14%. As the consumer spending, it remained resilient. And also it's witnessing improvement in user engagement, like the number of payment transactions per active user, they grew by about 13% year over year. And this was mainly because of the continuous product enhancements, like the integration of passkeys to speed the checkout process. And also the operating margins for PayPal, they have expanded by 100 basis points to about 15%. And this was mainly because of high operating leverage. Like its operating expenses, they dropped by about 1% on a year over year basis. And mainly the sales and marketing expenses, they were down by about 3 to 4%. Moving on to the negatives, the active number of users for PayPal, they dropped by about 1% to 427 million users. And this is mainly because of the PayPal, it focused on the highly engaged users. And also gross margins, they have been contracting over the last couple of quarters. And this quarter, it contracted by about 200 basis points to about 45%. And we believe that this was mainly because about 37% of the total payments volumes came from the Braintree unit, and this unit is basically a low margin business for PayPal, and as a result, it's impacted its gross margins. So moving on to the outlook for the second quarter, it expects a revenue growth of about 6.5%, and its bottom line GAAP earnings per share, it's expected to drop by about 10%. And this is mainly because of the one-time gains of strategic investments that the company had benefited in the second quarter of 2023. And if we exclude this and the one-offs like the restructuring costs, we expect the adjusted earnings per share to grow by about low double digits range. So in moving on to the valuations, we downgrade PayPal from buy to accumulate, whereas we also lowered our target price to 75 from $83. And this was mainly because of we lowered our EBITDA estimates by 2% in order to account for the high expenses like the restructuring costs. Like it had said that it plans to reduce its workforce by about 2,500 employees this year. So we overall for PayPal, we believe that it should benefit from its two-sided network effects, wherein it has a user base of 427 million users, comprising of about 390 million of consumers and about 35 to 40 million of merchants. And also it should benefit from a shift to digital payments. And that's all for me. I would now like to pass it on to Helena for Amazon.
Thank you, Ambrish. Good morning, everyone. Amazon has announced their first quarter earning of FY24 last week. Another quarter, a very strong result. We have published a report subsequently with the title More AWS Growth Ahead. So the first quarter revenue and PATMI meet our expectation at 22% and 26% of our FY24 forecast. Revenue grew 12.5% year on year to $143 billion US. This is led by continued strength in AWS and advertising. Operating income more than tripled. Part of this increase is because Amazon benefited from the lower depreciation after it changed the useful life of servers, extending it from 5 years to 6 years, which benefited them about $900 million US in the first quarter. There has also been very strong growth in margins. Its operating margin grew from 3.7% to 10.7%. So some pointers for positives and negatives. The first positive point is that AWS is showing more sign of reacceleration. The high growth is fueled by consumers migrating workload from on-premise to cloud. Generative AI services are also seeing a strong demand signal, evidenced by extended contracts and larger commitment. Their management has disclosed a significant increase in the CapEx for 2024 in order to boost their AWS growth. This indicates the company's confidence in its AWS expansion prospects. The second is the improvement in the margins. Amazon continues reaping the benefit of regionalizing its operation and has shown progress in bringing the cost structure down further. For example, they're trying to consolidate units into fewer boxes. So its first quarter operating income is at all-time high of $15.3 billion, beating the company's top-end guidance. Consequently, the operating margin stood at 10.7%, reaching double digit for the first time. This is a substantial increase from 3.7% in first quarter of 2023. Notably, the international business achieved positive operating income for the first time in over 2 years. Their AWS operating margin also reaches at an all-time high of 37.6%. We do notice, however, one negative point, which is Amazon hinted at potential signs of a slowdown in consumer spending. Despite growth in retail revenue, management did notice that consumers are being more cautious about their expenditures. They're seeking bargains and opting for lower price alternatives. So this trend appears to persist into the second quarter, especially for the European market. So Amazon has guided a revenue growth between 7 to 11% in the second quarter. In terms of the outlook, other than their guided revenue to be slightly lower, operating income is expected to be between 10 billion to 14 billion US dollars compared to 7 billion last year. CapEx is anticipated to increase substantially, driven by the increased infrastructure CapEx, which support the growth of AWS business. With such, we increased our PATMI by 4% to account for the lower expenses, which is a result of their improved cost efficiencies. We maintain the buy recommendation, but raise our target price from $215 to $220. So that is all from me. Now I pass my time to my colleague Glenn to talk about DBS.
Thanks, Helena. Yep. So for DBS, they released their results last Thursday. For their first quarter, PATMI was 2.96 billion. It actually rose by 15% year on year. And this was slightly above our estimates due to higher net interest income, fee income, and other non-interest income offset by higher expenses. So their first quarter adjusted PATMI was at 28% of our forecast. And also the dividends per share, or DPS, was raised 29% year on year to 54 cents. I'll jump straight to the positives. First positive being that their net interest income rose 7% year on year to 3.5 billion. And this was mainly due to 2 basis points increase in their NIMs to 2.14%, as the interest rates continue to remain high. And also the other factor was that their loans growth grew modestly by 2% year on year. And we have seen that the loans growth was actually broad-based, but more was seen in Singapore and India. And this was offset slightly by some of the Hong Kong loans dipping as it shifted back to mainland China. For the second positive was that their fee income rose 23% year-on-year to a record level of 1.04 billion. And this growth was led by wealth management fees, surging 47% year-on-year, and mainly from the stronger market sentiment, as well as an increase in their assets under management. And the card fees also rose 33% year-on-year from higher spending, while the loan-rated fees grew 30%. And all these increases were actually offset slightly by a decline in investment banking fees due to slower capital market activities, as well as the transaction services maintaining flat year-on-year. Lastly, for the positive was that their other non-interest income rose 24% year-on-year, and this growth was mainly due to the higher treasury customer sales, which were partially offset by a decline in market trading income from higher funding costs. Now, for the negatives, the first negative is that their specific provisions rose 82%, and their new NPAs also rose 45% year-on-year. The new NPAs were mainly from broad-based increases across all sectors, but it was also mentioned that the new NPA formation was idiosyncratic and that they do not actually see any particular stress in any particular sector. So you look at their credit costs, it did rise 4 basis points to 10 basis points. But it's still actually below their targeted guidance of 17 to 20 basis points. But nonetheless, if you look at total allowances, which includes both specific provisions and general provisions, it was lower by 16%. This was because the higher specific provisions were offset by lower general provisions of 22 million. So looking at NPL ratio, it was flat at 1.1%. And also their GP reserves grew by 4% to 3.93 billion. Lastly, for negative, is that their current accounts and savings accounts ratio fell by 6 percentage points to 51%, mainly due to the high interest rate environment and a continued move towards fixed deposits. So what does this mean, this declining CASA ratio? It could actually further increase their funding costs, and there could be an increased dependence on fixed deposits, which usually comes at a higher interest rates. So if you look at total customer deposits, it grew by 3%, as the decline in the CASA deposits was offset by growth in FDs, as well as a contribution of $12 billion from the Citi Taiwan consolidation. Now, for their outlook, we do believe that their GP reserves remain sufficient. You look at their CET1 ratio, it rose by 10 basis points quarter-on-quarter and 30 basis points year-on-year. So even despite increasing their dividends almost every other quarter, you can see that it has risen. And now their CET1 ratio is at 14.6%. So it's still at the upper end of their target operating range of 12.5% to 13.5%. So as I mentioned earlier, their first quarter DPS was raised 29% to 54 cents. We also noted that there is a need for DBS to return this capital because it's above their operating range, right? So there could be a possibility at a further increase in dividends, but nothing has been confirmed or mentioned in this first quarter's briefing. So we could look out for that in the second quarter or even in the second half of the year. Now, for the second part of the outlook, we're looking at their fee income. They have guided for double-digit fee income growth, so they've maintained it. And this will be coming from mainly their wealth management as well as their credit card fees. So for first quarter, they experienced better than expected momentum in wealth management as well as treasury customer sales. And they see that the same momentum is continuing in the second quarter. So at least the first month of the second quarter. And why is this sudden pick back up in their fee income, and wealth management? It's mainly because there was a sort of a shift in investment sentiment due to the expectation of quite a few rate cuts, where the demand and funds will move from these deposits like fixed deposits or even CASA into higher risk investment products, which are higher yielding for the bank. So that's one of the main reasons. And there's also further upside from cards from higher spending due to the ongoing recovery in travel. So that's for the fee income. Now moving to the net interest income, the DBS has actually increased their guidance provided in the previous quarter. So now they are expecting net interest income to be modestly better than FY23. They didn't give the exact figures, but they did say modestly better. So we are expecting maybe low single digit to mid single digit increase. And this will be sustained by the NIMs maintaining at the FY23 exit NIM level of 2.13%. For For total allowances, they are looking at to be around normalizing at around 17 to 20 basis points. And how they're going to maintain these levels is that because GP overlays of around 2 billion, which they have currently, will be released if their specific provisions is higher than expected. So this 70 to 20 basis points is for the full year. So for first quarter, you're looking around 10 basis points. I think we're on track to even be lower than this 17 to 20 basis points, which they mentioned. So as a result, DBS is guiding for PATMI to be above the FY23 levels. And estimate, I think we're looking around single to mid single digit, for FY24. So we do downgrade to accumulate with a lower target price of $38.50. And this is because we account for the recent share price performance, as well as the 1-for-10 bonus share issue which kicked in. So their base increase, which hence we lowered our target price. But we do increase our FY24 earnings by 2% as we increase the net interest income estimates due to higher NIMs, the higher fee income, as well as loan growth estimates. So we feel that the modest growth in net interest income from stable NIMs, low single-digit loans growth, as well as a double-digit growth in fee income will sustain DBS's earnings momentum. So that's all I have for the DBS and the banks. I'll now hand it over to Darren for the REITs. Thank you.
Thanks, Glenn. Yeah, I'll go over Cromwell's first quarter business update. Yeah, so for first quarter business update, their numbers were in line with our estimates. Their DPU were in line. So their revenue, top line, and MPI were down, mainly because of the divestments of 3 properties, Plaza Afari, Bari Europa, and Bari Tri-City. So if you exclude these 3 divestments on a like-for-like same-store sales basis, the MPI was actually up 5% year-on-year. Yeah, so as expected, they were affected by higher net finance costs. So that is the higher finance costs basically affecting all the REITs out there. Yeah, so I'll run through to the positive. So for the positive, the portfolio occupancy is expected to improve back to 95%. So right now it's at 93.4%, but that's because there were some redevelopment projects that were completed. So these completed redevelopments, they have not yet been fully leased. They've been included into the first quarter occupancy numbers. But as they are fully leased, we expect these redevelopments to be fully leased up by this year. So once they're fully leased, the portfolio occupancy is expected to go back towards 94, 95%. So right now, the portfolio rental reversions for the first quarter is at 9.2%. So this continues its trend of positive rental reversions. Is 6 consecutive halves or almost 3 years of positive rental reversions already. So this 9.2% is also higher than FY23's 5.7% rental reversion. Yeah, so the next positive is that they are making full use of the cheaper bond that is due in November 2025. So this bond is their next loan that is due for refinancing. They do not have any loans until then that are due. So their plan is to wait as long as possible to refinance this so that they can take advantage of this cheaper loan or cheaper 2.1525% bond and take advantage of any possible rate cuts. So maybe if they delay as long as possible, then next year, by the time when they refinance, the rates perhaps would have decreased by a significant amount. So then they can take advantage of that cheaper base rate to refinance the loan. Yeah, so right now for them, they have 86% of debt on fixed rate. And their cost of debt, it rose quarter on quarter slightly to 3.28. Sorry, there's a mistake in is 0.09 percentage points. It's not 0.9 percentage. Yeah, so the gearing right now is at 41.3%. The issue now is that we don't think there will be any refinancing risk for them because of their their solid portfolio and their good operating performance. So that's why we don't think there will be any risk of refinancing for them. Yeah, and they'll be able to refinance their loans in due time. Yeah, and for the next positive is that their divestments continue. They made 3 divestments year to date. So the stats are there, and all 3 divestments were sold above valuation. And they still have about 150 million euros of potential divestments that are in the pipeline, with 60 million already in advanced discussions. So this is part of their 400 million euro plan, a divestment plan that we started in 2022. Yeah, so this is to keep their capital management low and their gearing. They target below 40% gearing. Yeah, so for the outlook, they do not have any equity fundraising plans in the near term. And we've already accounted for the fact that they'll have some divestments in the pipeline and they'll make some more successful divestments. So we've accounted for the lots of income. And despite accounting for that, the DPU yield is still 9.2%. So we think that is attractive. And right now, the management is solely focused on managing this bond that is expiring due in November 2025. And they are also focused on the divestments of the 150 million euros. Yep. So with that, we maintain our target price and no change in our estimates. Our target price is €1.91. Yeah, that's all for me. I hand over the time to Meow Meow. Thanks.
Thank you, Darren. I'll go through Far East and Elite. So Far East for first quarter 24, gross revenue rose by 7.5% year-on-year to 27 million on the back of the leisure recovery, which was within our expectation, but DPU was not disclosed. Something positive about them is supported by the series of mega concerts such as Taylor Swift and Coldplay in first quarter 24. ADR increased by 8.8% year-on-year, reaching 179. However, occupancy rate slid by 1.5 percentage points year-on-year as Village Hotel Albert and Oasia Hotel Novena exited government contract at the end of FY23 and was remarketing them. Far East managed to secure ADR at 40 to 50% higher than euro during the concert period. And RevPAR for fourth quarter 24 increased by 6.7% year-on-year, reaching 102.9% of the pre-pandemic level. We expect RevPAR to maintain at the current level with slight improvement as ADR is expected to trend higher in the face of stable supply of mid-tier hotels and increasing international visitors, which STB target 15 million to 16 million for FY24. We also foresee an uplift in occupancy rate with a target of mid-80s in FY24. Furthermore, Far East also refinanced 164 million loan with 20 to 30 basis points lower margin. With the more hawkish Bank of Japan, the REIT is taking more time to screen for the DPU accretive acquisition. In first quarter 24, leverage ratios remain stable at 31.3% with debt headroom of 900 million. Assuming gearing at 50%, and the cost of debt for Japan saw a slight increment of 10 to 20 basis points, leading to a slight higher cap rate. This will compress positive carry by 0.5%, so landed to 2% of the positive carry. For negative, we expect fading recovery in FY24 as international visitors' arrival has already reached 91% of the pre-pandemic level. And SIA passenger capacity also returned to 97% of the average capacity in 2019. We may remain cautious about the, next is a service residency drop in RevPAR. RevPAR decreased by 1.5% year-on-year in first quarter 24. Some contracts were terminated earlier, leading to a sliding occupancy rate of 3.7 percentage points year-on-year. However, new contracts were secured at rate comparable to FY23 level. Far East saw more demand coming from the service and electronics and manufacturing sector. The next slide, please. For all hotels has exited government contract as has been ramping up well. Even Village Hotel Albert has met the forecast in March 24. Far East is actively marketing and directing some traffic to hotels in suburban area during peak period. Although hotels in Bugis and other central locations are performing well in terms of occupancy rate and ADR, we expect limited upside for the ADR as Far East caters towards the mid-tier travelers. RevPAR in FY24 is anticipated to recover back to pre-COVID level, and forward booking in May looks healthy due to packed MICE schedule and influx of international visitors. Far East is currently trading at FY24 dividend yield of 7.1% and 0.66 times price to NAV. We expect revenue to be supported by occupancy rate recovery and a strong second quarter 24 due to lines of MSA events, 30 days visa-free policy for Chinese travelers, and recovery of flat capacity. Our DDM-backed target price remain unchanged at $0.79, with projected FY24 to FY25 DPU of 4.35 to 4.45 cents. Yeah, next slide, please. Next one is elite commercial REIT. Gross revenue for first quarter 24 increased by 0.8% year-on-year to 9.2 million due to the rental escalation kicked in last year, March. However, DPU decreased by 21.2% year-on-year to 0.67 pence on the back of the enlarged unit base post-preferential offering. This is falling short of our expectation, assuming 90% of the payout ratio for the whole year. We identify some positives. It is expanding its investment mandate to living sectors, such as student accommodation, senior housing, or data center. Lindsay House is sorted for converted to a 40 to 200 beds student housing upon approval from the authority. Typical value for one bed is really 130,000 pounds with a yield of 5.5%. And annual income for the building would increase by 280% to around 1.4 million for a year. And the valuation would double to 38 million upon successful redevelopment. For data center, Elite is actively securing the power for the asset. We expect the process to take roughly around 1.5 years to complete the construction. And for negatives, we expect further downtimes from the vacant asset. In first quarter 24, there's still 7 assets remaining vacant, and 2 of them will be converted to other usage. And others will be either relet or divest. Dilapidation settlement would partially offset the earnings shortfall, with 4 more buildings expected to be received by the end of FY24. NPI is expected to be on par at FY22 level. And for outlook, given the counter-cyclical nature of Elite, since DWP tended to expand during the economic downturn, as more people claim unemployment benefit and seek help for career consultation, Elite is well positioned to be benefited from the downturn, despite the possible valuation uplift. Through expanding its mandate, we believe the effect won't be salient in the short term, given the long legal and construction duration and relatively small scale, since there's only 2 assets for redevelopment, versus they have 150 assets in total. And Elite is currently trading at FY24 dividend yield of 12% and 0.668 times price to NAV. We expect revenue to be disrupted by the 7 vacant assets and limited support from the dilapidation settlement. As government support tends to lag during economic downturn, we don't expect any major expansion in footprint from DWP in the short term. Our DDM-backed target price is lowered to 0.32 pence, 0.32 pounds due to higher than expected vacancy holding costs, with projected FY24 to FY25 DPU of 3.76 to 2.75 to 4.42 pence. Yeah, that's all for me. I'll hand over to Zhang for technical parts.
Thanks, Mel Mel. Good morning, everyone. First up, I'll talk about the S&P 500. So last week was quite volatile for the index. We saw a V-shaped rebound happen throughout the week. Currently, it's trading in this bearish spread highlighted in blue in the chart. So I think near-term wise, we're likely to see some consolidation ahead due to the still resistance around the 5,150 mark about there. So for the resistance wise, about 5,145 to 5,200, while the support is likely to be at 5,065 to 5,100 area. Next up for ETF monthly, we expect a lackluster month ahead in May for Bitcoin, Gold, as well as S&P 500. But Hong Kong should be continuing its stellar gains from April. So in terms of review of the April's performance for different asset classes, we saw a 2 to 4% decline for S&P 500, US Treasury bonds, as well as oil. While Bitcoin was the biggest loser, crashing about 17%. Then for gold and Singapore equities, they were both up about 3%, and the standout gainer was Hang Seng Index, which gained about 8%. In terms of the current trends, S&P 500, US Treasury bonds, and Bitcoin are currently in a downtrend. Gold and oil are likely to see some range consolidation, while uptrend is likely to continue for Singapore equities and Hang Seng Index. So in May, we expect further weakness for Bitcoin, gold, and S&P 500. Some range consolidation to continue for oil, and Hong Kong to extend its uptrend in May. So first out, looking at the S&P 500 ETF VOO, what we saw in April was a significant development, because in terms of the chart, there was a breakdown of this short-term uptrend channel in blue over here at the start of April, which led to a pullback that lasted a few weeks, coupled with a bearish crossover in MACD as well. So in terms of larger picture wise, we have actually saw a bit of a mean reversion back to the longer term main uptrend channel in black. So we could see some further weakness going forward for S&P 500. The next one is on the Treasury Bonds ETF IEF. So in April, we saw a breakdown of the range consolidation highlighted in blue, and then it's currently trading in a downtrend channel for the time being. But we expect some modest rebound in May, given the fact that yes, it actually retested a previous horizontal resistance level at about 91, and then and it's confirming the downtrend channel support as well. So we are likely to see some rebound this month. And next up is the gold ETF GLDM. So for gold, we saw a strong momentum coming at the start of the month in April, and followed by a pullback after in the later part of the month. So in May, we could see some further weakness as price has started to form a lower swing low along a downtrend resistance line. So possibly some consolidation or further pullback ahead for gold, with momentum tapering off on the MACD as well. Then next up is the oil ETF XOP. So a bit similar to gold, extended a strong momentum at the start of the month. Then afterwards, we saw price come off a little bit as it actually retested a high formed in June 2022. So with that, it's currently retesting previous this resistance breakout level at about 152. So we expect some sideways consolidation going ahead, but with limited upside due to the momentum tapering off as well on MACD. The next one is the Bitcoin ETF. So in April we saw it break down this pennant consolidation over here, which then afterwards we saw price actually come off quite a bit. So we could continue to see a further weakness for Bitcoin. Looking at the recent trend, could see possibly a retest of this uptrend support line as well, which will bring it to retest this previous breakout level about 22 to 23 US dollars, with a bearish crossover at MACD as well. Then next up is Singapore equities, which Singapore equities we saw a breakout of this range consolidation in blue over here. So it was a consolidation of about 3 to 4 months, and we saw it actually retest this long-term main uptrend channel resistance in this black channel over here. So judging from the prior instances where price actually retested this resistance level, we tend to see some modest pullback. So we could see some slight pullback in May, but I think in terms of the price action wise, it's likely to still remain quite strong with the recent breakout of this range. Then last but not least is the Hang Seng Index ETF 2828. So for Hang Seng, also is looking strong because as a breakout of this range consolidation over here in this blue color uptrend channel, and we saw price actually saw huge gains for the past 2 weeks. So I think we could see this momentum continue to actually reach 66 to 70 Hong Kong dollars resistance level. Now then next up, looking at the Thai SDR monthly, our view is that in May, Airports of Thailand, Kasikorn Bank, as well as PTT are expected to outperform the other SDRs. Looking at how the 8 SDRs performed in April, most of them were in the red, with the exception of CPO, PTT, as well as Kasikorn Bank, with Kasikorn Bank the biggest gainer surging about 10%. And the biggest losers in April were Gulf Energy with 8% decline and Delta Electronics, which was down about 6%. In terms of the current trends, most are either in a range consolidation or downtrend. Those are in downtrend are Gulf Energy, Siam Cement, as well as Advanced Info Service. Then in terms of the outlook for May, we expect Airports of Thailand, Kasikorn Bank, and PTT to outperform. Then we think CPO and Gulf Energy could continue the range consolidation. And in terms of the other counters, Siam Cement and Delta Electronics, we think that the price could extend its weakness in the coming month. So first up, looking at the chart for Airports of Thailand, price is currently still trading in this bearish flag over here, highlighted in blue, with a series of higher highs and higher lows. So with a retest of near the flag support in April, we expect to see price continue its rebound to actually extend this trend of higher highs and higher lows to do a retest of this downtrend resistance line again near the 68 baht level. Then for CPO, price is still kind of sideways for the time being. Also currently trading in this bearish flag highlighted in blue. But with near-term resistance from this downtrend resistance line, I think at about the 58 to 59 baht level, I think price is likely to remain kind of sideways in May. The next up is PTT. So PTT currently is still trading in this bearish flag highlighted in blue. If it holds the support over here at the 152 baht level, which was a prior resistance breakout level, we are likely to see some rebound ahead in this month as well. And next up is Gulf Energy. So Gulf Energy chart is still looking pretty weak. So it's currently trading in April, it actually retested a downtrend channel in black, downtrend channel support in black. Also, it broke down the range consolidation support level at 4140, but the range is highlighted in blue. So with that, it's currently doing a retest, but we think further weakness likely to be still ahead with a fresh range breakdown. Next one is Kasikorn Bank. So I think this is a standout in terms of the suite of SDRs. So very strong price action recently. There's a breakout of this downtrend channel highlighted in black, and then also looks like it's had a strong breakout of this range consolidation in April as well. So likely we are expecting to see price continue this bullish momentum towards the 140s baht level. And next one is Siam Cement. Also, in terms of the price action, one is still looking quite weak with a breakdown in April, continuing a series of low highs and lower lows, just trading quite near the downtrend channel support. So there's still some weakness going along, and I think we're likely to see some range consolidation for the time being. Then for Advanced Info Service, currently it's still pulling back in this the handle of this cup and handle formation. So rather sideways for the time being. Currently doing a bit of a rebound from the support over here, which is around 198 baht level. So we think it could just continue to do a bit of a sideways consolidation. And last but not least, for Delta Electronics, chart-wise is still looking, the longer term picture is still looking more towards the bearish side. Currently trading in this downtrend channel. Price is doing some sideways at the 72 baht level, which was the prior support term resistance. So I think over time, still likely to trend towards the downside. In terms of individual counters, first up, we have a technical buy for SGX at 937. Take profit levels at 955 and 978. Stop loss at 908. And the last close was 916 on Friday. So we actually lowered the take profit levels and stop loss levels by 8 cents to account for the XD that took place after the technical call was being made. So looking at the chart, there was a double bottom being formed at around the 890 level, and then subsequently price broke out of a downtrend resistance line. And currently it looks like it's in terms of in the chart, is doing a retest of it. So if it holds, could see the further upside to come to retest these two levels. With the bullish divergence recorded earlier, while it formed the double bottom as well. And next one is a technical sell on STAC at 92 cents. Take profit levels at 87 cents and 84 cents, with a stop loss at 96.5 cents. The last close was 93.5 cents on Friday. So looking at the chart, first up, it's currently trading this descending broadening wedge. And then secondly, it currently retesting the 94 cents level prior support, which acted as a resistance. So price is unable to get above this level, as well as break out of the wedge. With decreasing momentum of MACD, we think price could trend lower over time towards these two take profit levels. Now, so just to summarize the two trades initiated, first up, SJ is currently down about 2.2% and STEC is down about 1.6%. So that's all from me. I'll hand over time to Paul to give an update on Singtel. Thanks.
Yeah, thanks, Zin. So I'll move on to okay, go back to the cover page. So we came out with regarding Singtel, they announced some goodwill write-off, so that's why we call it accounting spring cleaning, but sprinkled with cash because they actually announced a deal to a $1.6 billion deal with TPG. Next slide. So in terms of, sorry for the background noise. So in terms of Singtel's announcement, they announced a 3.1 billion non-cash provision. If you look at the table on the left, that's where most of it comes from. A lot of it is goodwill and some of the assets. But at the same time, they announced a network sharing agreement that they will be working with TPG. So in Australia, there are three mobile operators. There's the incumbent Telstra, then there's Optus, then there's TPG, Vodafone. So the TPG Telecom is the same symbol. I mean, just that this is the Australian entity. So they announced that TPG doesn't want to build network sites in the region because it's so expensive. So instead, because most of their mobile phone sites are actually in the most of the mobile phone sites are actually in the urban areas. So as a result, because Optus already has these kind of network sites and they're going to roll out more, so they announced that TPG said, okay, never mind, I will pay you 1.6 billion over 11 years. At the same time, Optus also has they also need some spectrum which is not available to them, which is available to TPG. So Optus will also pay 420 million to them. But this 1.6 billion that you see here is actually net of this. So in terms of our view, I mean, no change. I mean, the headline grabbing news, I think probably hurt the stock, but for us, no change in our valuations, our forecasts. And net, this is actually a positive deal for Optus because somebody's going to share your capex. At the same time, you can just tap on the bandwidth to enhance your capacity. The last bullet point, so we still like Singtel because we think that mobile price repair, which is another word for higher mobile prices, is happening in most of their countries. They're still monetizing 4 billion of assets, including the Singapore Com Center, and they also looking to cut 600 million of operating costs. So to us, this is the most important, or 200 million per year. And there's this thing called the GPU as a service. So they're working with NVIDIA to set up GPU data centers only. So to just do AI processing. The amount may not be that huge because they don't really give much numbers, but it can actually move our EBITDA a little bit. The next slide. So in terms of Vector, for us, the title was that the first quarter was actually the first revenue performance since 2016. Next slide. So the results was within our expectations. The big positive is that they had net cash of 1.1 billion. If you look at the table on the left, you notice there's not much details because that's all they give. They give you one revenue, one profit, and then net cash, and good luck to you. So you just kind of figure out the rest. So in terms of the negative, the revenue continues to be weak. I mean, it's dialed back towards the 2016 levels. So it's actually weaker, just slightly above 2016, I think, or similar to 2016 levels. So this is an 8-year low in revenues. They attribute this weakness partly to destocking and life science network, but they don't tell you who the customers are. So in terms of the outlook, the most important, so Venture said that they are guiding sequential improvement. First quarter better than second quarter, which it's usually that way anyway. So I'm not sure how much information value there is to it. But anyway, they're just guiding that first quarter will be better than second quarter. It's usually that way because first quarter is it's Lunar New Year. All the factories are closed, everything shut down. So second quarter better be better first quarter. Then they also said that second half will be better than first half, which again, I'm not sure how much value is it there, but second half usually because there's Christmas loading and so forth. We maintain our earnings, our neutral, our target price all unchanged. They did highlight that one area that is a growth area for them is a data center, actually networking or rather optical products. So it is the, when you connect one data center to another, there are those optical fiber lines. So they are providing some of those electronics at the data centers. So that's what they meant. Next slide. So in terms of our usual Singapore weekly, some of the data were basically quite healthy for Singapore. I mean, the new orders PMI. So PMI is a Purchasing Managers Index. So you can use it as a way to gauge manufacturing momentum in the near term. Electronics was also the highest in more than 2 years. RevPAR, of course, was excellent, within expectations since we had the Taylor Swift event, but it jumped almost 20% year on year in March. So the 253 RevPAR, so RevPAR is, it's like the room rate, but you got to adjust room rate for occupancy, because most hotels now are probably 80% occupancy, but it's actually the second highest RevPAR on record. I think the highest was, December of last year, or November. Retail sales Singapore probably a bit slowing down, so that's not so great. Yeah. In terms of the payroll, so this payroll was the one that hit all the headlines in the US and probably helped the market a bit. So the payrolls in the US was 175. It was below their estimate and was far below the prior month. We find it a bit curious. We think the number might be a bit understated. Why we say that is because when you look at the numbers, actually government's jobs totally collapsed. I mean, it almost disappeared from 72,000 in March then to 8,000. Government jobs in the US normally add 50, 60 to 70,000 a month. So suddenly 8,000. So we think there could be a big revision to the numbers because 8,000 is probably like a record low, excluding the pandemic. Yeah, so it's a bit it's an anomaly there. So it's a bit strange why the thing dropped. But even having said that, some of the data coming out from the US, very near-term data, is actually there's a bit of a softening. So the PMI new orders is 4-month low, then consumer confidence is 21-month low. So there's a bit, nevertheless, there's still some softening in the US data. Next slide. So in terms of our technical views, so for us, we think, okay, right now the market is actually pricing maybe 1 to 1.5 times cut in 2024. No, one cut is basically 25 basis points. So the market is pricing maybe 30 plus basis points. But for us, we think the window to cut is actually shrinking very fast. Because firstly, inflation is still too high. So that rules out the upcoming June and July. Because it's going to be, I don't think the inflation can drop so fast to 2% for the Fed to cut. And then it's going to be very political to cut in September because there'll be presidential debate. And if you cut during a presidential debate, then the Republicans will complain, you're helping the president. Then if you cut in the November, just after the elections, then the Democrats will say why you didn't cut earlier. So although the Fed doesn't explicitly mention, but it's going to be very political for them to cut in the September, November. So that leaves only December to cut. And even then, there's still, we worry that inflation is going to accelerate in the second half, in June onwards, because gasoline, commodity prices are all still rising. You also have this base effect because second half of last year, there was a very sharp disinflation. Prices came off a lot, and most of it actually came from goods because the supply chain are normalizing. So the goods inflation, disinflation, that means goods inflation keep coming down, the goods prices keep coming down, mainly because supply chains, you're not going to get that benefit too. So what this means is that it's going to be positive for banks, but of course, some of it's already priced in. But the market is really pricing. But we think the upside for banks is really going to be the dividends, be it either DBS or especially OCBC, because their capital ratios are just record high, some obscene CET1 or 16% or so. In terms of the events coming up, so we have OCBC by Friday. Then tomorrow we have Cromwell REIT if you want to know more, and then we have AIMS ESR logo. So we have like 3 REITs presentation. Tuesday, Wednesday, Thursday. It's open to anyone who wish to listen in. Next slide. So I'll move on to Wilma, our Phillip on the ground. So Phillip on the ground basically means we don't have coverage, but we attend all these NS briefings. So we just share with you, what we learn, because most may not be able to get access to these meetings. So for Wilma, those who may not know, they are 20 billion company. They are mainly palm oil plantations, refining of palm oil in Indonesia, Malaysia. They do soybean crushing to get the meal so they can feed the hogs, and then edible oil, basically cooking oil, but consumer pack, not bulk pack like in rural areas in China. The financials was weak. If you look at the table on the left, the core net profit, you notice it dropped 14%. That's mainly because of sugar. So sugar actually was the spike in sugar prices. Actually, I should put they also have a sugar plantation and sugar refining. So I forgot to put that, but that actually helped the earnings in the second half of last year. But that sugar prices came off, so that kind of dragged earnings. They also highlighted that the refining margins in Indonesia are still weak because there's a lot of capacity that was built up during the pandemic. Refining margins were at record high, so there was a lot of capacity being built. In terms of their comment for palm oil price, which is the most important, they said that production is actually quite slow in Indonesia, so which is usually good for palm oil price because no supply is tight. But the problem right now is that the palm oil price is at a premium over sunflower oil and soybean because there's going to be a huge supply coming up for soybean and sunflower. So palm oil price is now at a peak, at a premium, that means higher. But usually it's not that way. Usually palm oil price is at the discount. So you're going to see a lot of switching out from palm oil. So that's why they said demand is weak. There was some news on the Ukraine damage. They said the impact, the missile, I think some missile hit their Ukraine facility. Yeah, but so they said the damage is 13 million. Not really impactful. This company is making like 300 million per quarter. So the financial impact is not much. And I mean, if you're interested to know, they can't claim insurance because it doesn't cover war risk. For crushing machines, which is another important part of their business, there is a slight improvement because hog prices in China slight improvement, and then the softer soybean crop can improve. But anyway, just to go to the conclusion, the outlook, we expect second quarter to be soft because China consumer demand is still soft, then palm oil price not rising, and then sluggish refining margins and crush margins. So it's going to be weak for the second quarter. Next slide. So I'll move on to our usual model portfolio. So the one that did well for us was the banks, as the title suggests. Then Cromwell REIT, that was up 8%, and Transport or Comfort they'll grow. What was the drag was Keppel and also Singtel. Singtel is probably after the Keppel Limited was probably because when the results came out, they didn't really announce much divestment. So, and the earnings was generally a bit lackluster. So I guess the market was a bit more disappointed. The table on the right is just some of the performance compared to the STI ETF. Next slide. So here we have the okay, this is just a snapshot of the sector performance. The one that did well was shipping, mainly because of Citrum. So Citrum did well also because oil price, and they also announced 100 million share buyback. But we are not sure why the share price, because the 100 million share buyback is for employee shares and also director fees. So I'm not sure why is that good for the stock. But anyway, then the other thing is that the one that did well is of course the banks. So the top 10 gainers and losers you see here is just some of the stocks that probably there's more activity, more trading. So we just put there. And the bottom is more the STI index kind of gainers and losers for your reference. Next slide. This is just to show some of the asset winners. So what did well has been commodities and gold for month of April. In blue is the year to date. So commodities, you can see there's a big turnaround in commodity prices, which is also a problem because it's going to push inflation up. Singapore was here, and then the REITs was one of the worst performers year to date and also for the month of April. Next slide. So this is just my last slide. So this is the Asian stock markets. So we just wanted to know in April who did the best. So Hong Kong was the best performer. This local currency. This is not US dollar adjusted. So Singapore banks actually did quite well. But the best performer could be even globally is actually Hong Kong. And the worst is Vietnam, Japan. I think you can see for your own reference here. Okay. Thanks. I think we can move on to Q&A.
Maybe sorry, Ambrish, maybe I'll just take it first. Quite a few questions on DBS. All very good questions. Thanks for the questions. Yeah, sorry if I couldn't go so much into detail during my presentation earlier. Otherwise, I think I'll take like 20 minutes. But anyway, so I'll just go through these questions one by one. First one being, what is this city integration cost for one-off expenses mentioned on DBS's results? Yep, so this is when they acquired the City Taiwan. So they have this called one-off expenses. I think last quarter it was like 100 plus, so now it's down to 5. And I think we could see it start to roll off, and you see it sort of disappear from that line in the second half of the year. So basically they need to spend money to integrate the City Taiwan into DBS. Yeah. So basically that's the one-off expenses. So all the banks have it as well. UOB has it for their city assets too, and then now OCBC, I'm expecting them to have it for when they acquired the PT Bank Commonwealth in Indonesia. Okay, may I know what is market trading income mentioned in DBS's results? Income from DBS Vickers? Yes, you are partially right. So this market trading income actually consists of they integrated this two of the groups. So let me go into more detail. They renamed it Global Financial Markets. So basically, it's merging the equity capital markets, the brokerage DBS Vickers, as well as the DBS Digital Exchange with its existing treasury markets business. So yeah, I think part of it comes from Vickers, but also from their treasury markets as well. Okay, yeah, someone asked, how do you calculate the increase of the dividends? And they mentioned that the DPS for first quarter 23 was 48 cents. So yeah, I think it's a bit of a typo on my side. It shouldn't be 29%, it's actually higher because the first quarter DPS was 38 cents and now it's 54 cents. So the increase should actually be 42% year on year. Okay, next one. They ask about the CET1 ratio. So I'll just read the question out. Can you explain what is CET1? And we keep hearing that there is a need for DBS to return capital to shareholders via possible special dividend. Is this capital coming from earnings or AUM, and why DBS never used this to expand its business? Okay, very, very valid question. So CET1 is Common Equity Tier 1. It's basically their strongest kind of capital which they have. And for all the banks, they are looking at 12.5% to 13.5%. So that's when they're not keeping too much capital and not keeping too little capital. And it's still above the MAS regulatory requirements, right? So for them, they don't want to keep so much of this sort of like cash. And okay, so to your second question, where does it come from? It comes from earnings, where they retain earnings and then they put it back into their capital. So they want to lower it because then, it shows that firstly, they are giving it back to shareholders or they are expanding their business. And, your last question, you asked why DBS never used this to expand its business. It actually did. So you look last year, they did buy the City Taiwan assets and they used it that's why the CET1 actually lower a bit, right? So we are looking at the CET1 now, it's still very high, even though they are giving back so much dividends and they are even had the 1-for-10 bonus share issue. And that goes very nicely into the next question, which is asking, what are the chances that DBS will be able to maintain the 54 cents dividend payout per quarter for the remaining 3 quarters of the year? Very highly likely they'll be able to maintain this 54 cents. Actually, if you look at it, at least from our estimates, it would probably actually even increase. This 54 cents might be higher. So what was mentioned during the call and what we are getting from the information provided to us is that they want to lower the CET1 and they have to lower the CET1 ratio, right? To meet I sort of like to appease the shareholders as well, right? And they just did this very big acquisition with City Taiwan. So I don't think a very big acquisition is in the near future for them because they're still trying to consolidate City Taiwan. And what else can they do is to increase dividends. How will they do it? We are not very sure. Also, when will they do it? We are not very sure. But it could be coming in this year, where if their earnings are maintained, and I just presented earlier how are they going to maintain their earnings, then it's highly likely that they're going to just accumulate even more capital, and they will have to return this. So it might come in the form of a special dividend, or it might be in the common dividend. But we are not very, very sure how it will come in. But I think the next quarter we'll probably have more clarity on this, and we'll be able to update you again.
Again, how much can you let people know, like the Basel, how much capital will be released?
Oh yes. So if you look at the Basel impact, so there's this new thing. So maybe it's hopefully not to confuse everyone, but they're shifting to Basel. Now we're using Basel 3, right? The reporting standard, and we're going to Basel 4, where it will actually add 200 basis points of of CET1. So just give me just 5 seconds to just pull up. I have it right here with me. So we are looking at around 200 basis points of additional CET1, and that will be sorry. So we could be looking at around, for DBS, right, it's around 7 billion. If these 200 basis points increase, so now they're around 14%, right? If it increases to around 16%, it's around 7 billion for this, just because of this change in the reporting standard, right? You could add another 7 billion to their CET1, and that's additional capital which they don't really want to hold, right? So they might release further.
How much dividend does DBS pay now?
They pay 54 cents per share. Hold on, let me get that figure. I'll get back to you on how much dividend
Yeah,
they pay.
okay, so any DBS pays about 6 billion. So the capital release will be 7 billion. So technically they can actually continue paying, right?
Yes, correct. Yeah. So they can continue to pay very high, and actually they still have another buffer of like 1 billion, right? As what Paul mentioned. So, and then on top of that, if you look at their earnings, if it keeps continuing at the current pace, then they're going to be quite sort of like keeping even more capital. So there'll be higher dividends going into the future. Oh, is that all? Sorry, let me just look through again if there's any other questions for me. Yeah, I think that's all for me. Yeah, thanks. I'll hand it to the rest of my colleagues. Thank you.
Thank you, Glenn. So there was one question for me. Please update on Block. So basically, Block, it had reported its first quarter results on Friday last week. So in terms of its revenue growth, they grew by about 20% year over year, whereas gross profit grew by 22% year over year. And company, it mainly focuses on gross profit as a key metric mainly instead of revenue, mainly because it considers its Bitcoin revenue as a pass-through. And the main drivers for Block in the first quarter, they were basically, it's a cash app segment, which basically offers digital banking services to underbanked consumers, as well as it also lets consumers to invest in equities and purchase Bitcoins. So the gross profit for this segment, it grew by about 25% year over year. And this was mainly led by the monthly active users, which grew by about 7% year over year to 57 million users. And management also highlighted that there was a strong adoption for its debit card services, and the number of users that have been using its debit card, they grew by about 20% year over year to about 20 million users. Whereas it's a Square segment, which mainly lets merchants to accept payments and also provides hardwares like a point of sale solutions like card readers. So the gross profit for this segment, it grew by about 20% year over year. And this was mainly led by the resilient consumer spending on its platforms. And in terms of outlook, management, it had raised their outlook for the full year 2024. They have now raised their gross profit outlook by about 200 basis points from 15% growth to about 17% growth, and it continues to focus on profitability. And as a result, they now estimate adjusted EBITDA of about $2.7 billion, up from about $2.6 billion. So I hope that helps. That's all for me. I would like to pass it on to the rest of the team.
Yeah, thanks. Let me just try to answer some. Okay, your comments on LHN for the next 6 months. So LHN announced profit warning that the earnings may not be, the earnings will not go below 14.5 million, if I'm not mistaken, PBT, compared to the 20 million that they recognized last year. But 20 million last year included some disposal gains. So they are just to go into the details. So the disposal gains last year was probably about 6 million plus. So that's number one. Number two, there are two types of disposal, one-off gains in their results, if you want to be a bit more detailed, because in they are the obvious ones, when you sell property, that there's also this thing called gain on sublease, which is a bit more of an anomaly. So what happens is that because when you are leasing a property, let's say out of 9 years you lease, then when it comes to when you lease it back the last 3 years, you actually, or the last 6 years, you actually recognize a gain on sale because your lease is so short. So the accounting consider it that you're disposing the asset, which to me it doesn't make sense. But anyway, it causes very lumpy earnings for LHN. So that's why you get that. But that 14.5 million is actually in line with our forecast. So our PBT forecast for 2024 is about 28 million. So I think it's just generally in line with forecast. Just that they did probably they didn't even structure the PR announcement that well. It seems to be kind of a shocker, but there's actually a lot of one-offs in the prior year, so that's why they gave this kind of warning. Yeah, I'm not sure why anyway, but just get okay, because it's all one-offs rather than the underlying business. Okay, based okay, any news on the Jaffa is actively moving up privatized? Okay, so Jaffa, I only heard part of their results briefing. I have to listen again. So the results did better than expected. There's a bit of timing, so they actually kind of warned the analysts. I didn't do a Phillip on the ground because I didn't hear the whole thing, but they kind of warned the market that this is because this year the Lebaran or the Hari Raya was earlier than expected or later than expected. So they managed to catch the full festive period rather than the last year. So that's why the earnings was a bit higher because the poultry prices or the chicken prices kind of surged out. So they just kind of warned that this thing is a bit exceptional, the results. So in terms of privatization, you can never rule anything out, but it's going to be very challenging for them to privatize. So why we say that is that their market cap is about 600 million. Their net debt is also about 600 million. So whoever wants to privatize, you actually have to, if I'm the major shareholder, I want to privatize the remaining, I think, 50+%, if I'm not mistaken, or 40+%. Not only do you have to gear up to buy that equity stake, now you have to also absorb the gearing or the debt. So basically, you got to take two levels of debt to go and take this out. You got to borrow to buy out the minority shareholders. Then once you take on, then you also have another layer of debt technically you also have to absorb the debt at Jaffa level. So you're not buying at 600 million, you're buying at 1.2 billion because the enterprise value. So I think any privatization a bit of a stretch out for my own view, but I mean, at least it helps give some turnover to the market. Yeah. Any update on okay. Nothing much for me on Dynamics. Sorry, there wasn't anything. Now, venture net cash 1 billion. Are they gearing for privatization or acquisition? Okay, I think they will probably be a bit more aggressive. Sorry, the question is venture has 1 billion plus cash. Are they gearing for privatization or acquisition or shareholder distribution? Yeah. Okay, so probably they probably have been talking about acquisition the last 10 years, but of course it must be cheap, it must be like fantastic, like the perfect bride kind of thing. But so I'm probably gonna rule that out. Privatization, the only thing that holds us back on them privatization is that they do issue a lot of employee share options. So even Mr. Wong himself also gets a lot of share options, executive share options. So if they do this, if they privatize, then they're not going to get this benefit of the share options from the stock market. So that's my own view. So I think unlikely because they are actually paying some of their staff. They pay a lot of their compensation to staff through share options. So that's why that kind of holds me back. Why whether if they want to privatize, then they have to whoever privatize then now have to pay the employees cash to get that benefit. Or at least right now you can tap it from the stock market. Although the share price not like doing that great, but at least you can still tap it from the stock market. But if you privatize, then then you have to come out from your pocket and pay cash to the employees, and of course you also have to pay Mr. Wong that the compensation. Where I think 80% of his 7 million or 8 million pay comes from is variable related, and some of them is all short options. Yeah. Can you give an update on Yoma? Yeah, Thompson. Sorry, I don't really anything. No new updates. There hasn't been any particular briefing. Yeah, from Yoma. For Yoma, it's mainly all politics, but they'll be releasing their results soon. So sorry, nothing. No new updates from me. Yeah. Can you share the latest on Tasin or Tasin? I'm not sure. I don't really. What's your view on Genting outlook? we think Genting still can do well the next few quarters based on the tourism number, RevPAR numbers. And wait for the Marina Bay Sands results. So I'm not sure when the Las Vegas Sands results where they will provide earnings on Marina Bay Sands. But I mean, for my own view, I think still positive because the tourism numbers are still very strong. So tourist arrivals in March is probably up by 50%. Yeah, so that's why we think it's still Genting Singapore will still have that momentum. Yeah. Thanks. Azin and Miao, can you take that one?
Yeah. Thank you, Paul. Far East Hospitality, any visibility on the institutional interest in the country? Seems daily volume is low. Yeah, we don't think the institute interest for Far East is high. Currently institute only holds around like 20% of Far East Hospitality Trust, and sponsor related companies holdings about like 53%. Yeah, so it's just not enough like floating shares for institute to take more. I hope it answers your question. I'll hand over to Zane for the technical analysis. Thank you.
Okay, thanks, Miao Miao. I will start with the TA. Okay, so first up is on Sembcorp Industries. So I think for now it's relatively sideways. It's for the past 1 week of action. So I think that will likely continue. With trading around, should be trading about 530 to about 545 for the time being. And next one is on Keppel. Okay, Keppel also quite sideways for the time being. Still finding resistance from a retest of this price support at 695 area. But then price currently is around, there's some support at 680. So I think we're likely to still see some sideways consolidation between 680 to 695 in the near term. Okay, then next one is on Ascendas REIT. So I think for Ascendas, slightly also range bound. Currently, recently did a retest of this 253 level and saw a slight bounce. But I think likely the resistance will still come around 265 for time being. So I will expect some sideways consolidation as well. Okay, then CICT wise, I think it's rather still rather sideways. Could be trading in this blue slightly downward channel over here. My recent price action currently seeing some pullback from the resistance about 198 to $2 area. So I would expect we could see the share price pull back a little bit more. But support is likely to be around 190 area. So possibly some slight pullback to range bound going on. So next one is on Google. Okay, for Google, after the gap out following the results, some starting to sideways a little bit with some support at 163 level. So 163 will be this retest of this trend line breakout over here. So I think we could see some slight bounce going ahead to retest like 170 to about 175 about there. So I'm expecting some rebound to take place. The next up is on Amazon. So for Amazon, the earnings over here, price crept up to close to the 188, 189 highs over here. So I expect a retest over here and afterwards some sideways consolidation. The next one is on Broadcom. Okay, for Broadcom, recently still finding some resistance from retest of this 1,300 level over here. This price a strong support level. Price has pulled back slightly, but for now there's a higher low being formed. So I think price could still inch up higher to try to retest this recent resistance again at around 1,300 over here. The next one is on ARM. So for ARM, quite sideways range bound movement over here. Still seeing some resistance at 103. So you could still see some pullback, some slight pullback towards the recent support from around 96. About there. Then I think we just kind of sideways before their results release this week. This one is on Tesla. Okay, Tesla seen a jump after going this gap out over here. Then price has started to did a slight pullback to retest this price resistance level at 170 and 180. So I think likelihood is that this level will hold as a support for now, and likely to see some bounce again to retest the recent resistance at about 195 to 200. Okay, next up is on Salesforce. Okay, for Salesforce, generally still quite range bound in 260, about 268 to 280. So I think that hasn't changed, but likelihood is that we see further weakness should it break down this level. Then we'll trend towards like 250s, low 250s over there. Given that price is still forming lower highs and lower lows in this trend reversal. For Square, okay, Square, I think likelihood is that price could still trend lower because after the things over here, you still see it finding resistance on downtrend resistance line, lower highs, lower lows, and then likelihood is that price still could trend a bit lower towards like 63, 64 to retest these swing lows over here, confirming the channel support. Next one is on Mapletree Logistics. Okay, Mapletree Logistics currently doing some slight bounce from the 130 level, but I expect some resistance to come in around 141 prior support level. So 141 to 144, I expect this resistance to act in, and afterwards see a slight pullback and price starts to consolidate again. Next up is on iFast. So iFast, I think recently managed to break above this 710 level over here. Then price kind of sideways for a while over here. So I think near term wise, it could still trend higher to test the resistance around 770, 780 about there. Then I think afterwards it likely to just trend sideways. Yeah. Also the volume is also shrinking over the days as well. Next up is Samudera. Samudera for now, I think it still remains in this uptrend channel over here. Currently doing a retest of this breakout of the 89-cent level. So I think over here, likelihood is that for the time being, should be able to find some support around 88 cents to 89 cents level. Then we could see some bounce. Okay, then next up is on AEM. So AEM, I think nothing too much. Still just trading this, mainly trading this blue color uptrend channel over here. Price is still rather sideways. Yeah. So last Monday was a flag up, but then came back down underneath this 242, 243 level. So I think price is likely to trade slightly lower this week between 230 to 240 about this range. Okay, then next up is for Franken. Still trading this downtrend channel over here, but near term wise, I think slightly you'll find some support around 135, 135 to 138 over here. So I think likelihood is that I think sideways action, given that also some near-term resistance around 140, 141 with the recent breakdown. Next up is on Alibaba. So Alibaba recently some strength breaking out of this 76 level with this gap over here. So I think likelihood to actually fill this price gap at 80. So I think for now it could do some sideways for a time being. But in the longer term, we are likely to see price trend higher towards like 83, 84 to retest this resistance. Okay, the next one is on BYD. So BYD is recently broke above this 216, 217 resistance, then went to retest the prior support level at 230, now acting as resistance. So I expect some slight pullback on and consolidation going ahead for a time being. Okay, next one is on Meituan. Okay, Meituan is still showing some strength, but with the breaking above this uptrend channel resistance at 106, but price actually did a retest of 120, this prior range resistance. So likelihood some sideways ahead, going ahead with support 113, 114 about that. So some slight consolidation is likely. Then next up is JD. Okay, so for JD, I think also recently there was a break above this 110. So I think likelihood is that could retest this 128 to about 132 area. This prior support, then turn to resistance, then some sideways afterwards. Yeah, so quite similar across the board for the Hong Kong counters. This one is on Far East Hospitality Trust. And for Far East Hospitality Trust, I think you can see from the chart it's still rather sideways. So I think that will still likely to continue between around the 60 cents to 63 cents mark over here. Well, nothing has actually changed. Then for Silver Lake is currently pulling back after a surge. Yeah, so and then actually we tested this prior support and resistance at 27 cents. So I think for time being, likelihood some pullback towards the prior breakout level at 24.5 cents. So I think this will likely be a support for time being. Then price will sort of consolidate between 24.5 cents to about 26 cents for the time being. Okay, next up is CSE Global. So CSE also a very range bound counter for now. It still resistance at 44 cents, support around 41 cents. So nothing has actually changed. I'm still seeing this range bound pattern. So I think that will still continue. For Centurion, likely to find some sideways price action going ahead with after the surge in volume over here, price went up, and afterwards you have this drop off in volume and price actually sort of gone sideways. So I think likelihood is that some consolidation hit between 48 cents will likely be the support. Well, here then resistance will be the recent highs at 52 cents. Okay, next up is Fraser Logistics and Commercial Trust. So for this counter, recently did a retest of the 97 cents mark over here, this swing low, and some recovery to retest this broken range support of about $1 over there. So I think likelihood is that some sideways consolidation for time being around this level, around the $1 level, yeah. Then resistance upwards will be around 103 about there. Okay, for UMS, I think price is still rather sideways for a time being. So still some weakness because it's currently unable to reclaim this prior uptrend support line over here. But then it's still holding on to the support around 129, 130. this range support. So I think rather sideways for the time being, but resistance is quite near with around 134, 135. So likelihood is that you move kind of sideways. And then for STAC, I think I shared earlier just now, I think it's still trading in this descending broadening wedge, finding resistance along this trend line. Also, it can't break above 94 cents convincingly as well. With that as a prior support and currently turn into resistance. So my view is that it continue to trend slightly lower in the short term. Okay, then for Seatrium, some pullback after hitting this previous resistance at 0.096. So I think with that, likelihood is that we could see some slight pullback to retest this 0.088 level over here, then price move sideways afterwards. Okay, then next one is on StarHub. So StarHub zooming out, did a retest of this 122 swing high form in December 2021. And currently, I think it's doing a retest of this 116 prior resistance level. So I think this support over here will hold and price will likely do a bit of a bounce and just trade sideways for the time being. Okay, there's a question based on venture chart. It looks like a V-shaped recovery and daily share buyback. Yeah, advice. Okay, in terms of the chart wise, V-shaped recovery, I think it's still kind of sideways for the time being. Price is still holding on to the support around the $14 level, about there, but it's still unable to climb convincingly back into the channel above 1450. So likelihood is that it will just kind of trend sideways for the time being, my opinion. The next one is on SMCI. So SMCI, I think last week it actually retested about the $700 support for the time being. Then we had some sideways over here. So I think price could do a little bit of a bounce higher to retest about 840, 850 about that. Maybe to fill this gap, but then I still expect a lower high to be formed given that it's still currently in this downtrend, trading this downtrend right now. Okay, next one is on AMD. So I think AMD for the time being, it looks like a double bottom currently being formed at 145. So if this follow through this candle from this indecision over here, so I think likelihood is that we could see some bounce ahead for AMD first up to maybe to actually fill this price gap 158 to 162 over here. Then it could just trade sideways for the time being. Update of TA for Dynamic. Okay, Dynamic currently showing some weakness because pulling back from this 41-cent mark also broke down this uptrend channel it was trading in. So for now, I expect a retest of this 36.5 cents level, this prior breakout level, which price is already quite near at. So probably some bounce going ahead, but I expect a lower high to be formed with resistance of about 39 cents for the time being. Okay, then moving on to the TA for the three local banks, I'll start with DBS. So DBS, I think for the time being, still very strong price action. Yeah, but then sort of just move sideways after the results gap up over here. So for the time being, I think we could still see some sideways price action given the tapering off in the volume. Yeah, then currently it still could do a reconnect in the 5-day moving average, which is in blue over here. Then afterwards you could see some bounce, but maybe still some resistance around the $36 mark. So I would guess some sideways price action in the near term, but the longer term trend is still very strong. As for UOB, also kind of sideways for the time being. Yeah, volume has also dropped off a little bit. Yeah, so I expect it to hold around the 5 to 10-day moving average support, so dynamic support over here. Coupled with the recent swing low level of about $30.30. So yeah, about there to find some support and likely to trade sideways to do a retest of $30.80, $30.90. Okay, then OCBC also quite similar, also starting to sideways for the time being. Support will likely be around about 14.10, 14.20 level, about there. Yeah, also the chart is pretty much similar to UOB, currently trending near 5 to 10-day moving average area. Okay, for Mapletree Logistics Trust, currently doing some. Okay, wait, I think I went through this earlier. I'll move on to Genting Sing. Okay, for Genting, I think for time being, largely I think it's gonna trade this range with between 88 cents to 91 cents. But some weakness in the short term was that up with this gap down over here, below the 91 cents mark, where price actually tried to go above. I think it's a sign of some short-term weakness. So this will become a near-term resistance. So I think it's either going to trade sideways between 88 cents to 91 cents, or it could trend lower if should the support over here be broken. If for Comfort Delgro, I think for timing today, there's a gap down over here because of the XD. So, but for now, kind of sideways, I think between 142 to 150 level over here, and price, the longer term trend is that it's still trading this blue color uptrend channel. So I think nothing too much has sort of changed. Just kind of some sideways consolidation for time being. The next one is on Nanofilm. Okay, Nanofilm, I think it's probably doing some sideways consolidation within the wedge itself at this downtrend resistance line. So I think we still need to see the outcome, whether it breaks down or breaks upwards. And that will likely dictate the next move. Near-term resistance, if it breaks upwards, will be around 70 cents, 71 cents. If it breaks below that, then likelihood is that it will come back to test about 63, 64 cents level. The next one is on Jardine CNC. Okay, Jardine CNC quite sideways for the time being, I think. With near-term resistance expected around 27.20 on this previous range resistance as well as the current range resistance. Then we also have this long-term downtrend resistance line acting as well. So I expect probably price will just continue to sideways for the time being. The next one is on Capital REIT. Okay, Capital REIT, I think generally is still in this downtrend over here. We're still seeing lower high being formed and the lower lows on the base. But for the near term wise, looks like some sideways action between 86 cents to 88 cents. Okay, then afterwards is on Apple. So Apple, after the earnings, there was a gap up over here. Currently selling off a bit, but I think should we come lower towards 179, 180, this level, it will likely act as a support, given that this was a prior support breakdown. Also then turn into resistance. So this is a key area to watch out for. I think we still need to see more trading sessions to see how it goes. It's on Hong Kong Land. Okay, for Hong Kong Land, I think some bullish momentum recently. Break out this downtrend resistance line and then price climbing above these two resistances around 318 as well as 321. So I think we could still see price go a little bit higher towards 333 to retest this level here. Then we'll see price kind of sideways afterwards. Next one is on Yum China. So Yum China, I think overall is still trending down, still undergoing a downtrend over here. Yeah, then I think likelihood is that probably could do a bounce, but lower high is expected between 39.30 to about 39.80 area, which is this gap over here. Then for Baidu, I think largely still quite sideways. Still, so it's rebounding back towards this range resistance area between 112 to 114. So I expect some resistance to hold over here and price to just pull back slightly and sideways afterwards. Okay, next one is on Microsoft. So Microsoft, I think near term wise, we are seeing a double sort of a double bottom taking place at 390 with a very quick retest over here. So then it's bouncing upwards now. So I expect slightly more upside towards to actually do this retest of 412. Then it could consolidate over here. Still largely in this range over here. Okay, next one is on TSM. So TSM, I think some positive after finding resistance at 139 over here, which was a price support. Friday there was a gap up and then actually cleared this resistance. So I'm expecting some further upside towards 145 as the in the near term for TSM, which was a prior resistance area. Okay, I'll do one more before I hand over time to back to my colleagues. It's on CLI. So for CLI, some strength recently. The breakout of this downtrend resistance line and currently doing a retest of this prior resistance zone, which is around 265 to 270. So I think price will hit this area over here and then it could consolidate slightly afterwards. Yeah, so I think that's all from me. I'll hand over time to my colleagues to answer some of the other questions.
Yeah. Okay. Let me answer something. I'll hand it over to Miao. Yeah. Seatrium after consolidation come by. We are actually quite negative on Seatrium fundamentally, but I think people don't really look at the fundamental. People just buy this stock as a proxy to oil price. So I think for that reason, I think that's fine. Yeah, but I think we mentioned before. I think the challenge for Seatrium is that even their targets are not very aggressive. They still have almost 800 million to pay in terms of penalties, in terms of restoration costs for the yards that they taken over after the merger. Then they're going to gear up the balance sheet. I think 700 to I think 2 billion or 3 billion. And even the growth that they're giving isn't too attractive. Mainly because of there are other ways to play oil and gas. So oil and gas is performing well. But the other ways to play, we think could be guys like even Pacific Radiance, Marco Polo. For us, this is a better way to play oil and gas. Yeah, because there is a real jump in rates right now. So all the offshore vessels the charter rates are all like almost record levels or back to 2014. If you read our weekly strategy comment. So we met some of them and that's performing. For us, there's a better way to play oil and gas right now than Seatrium. But having said that, like we said, Seatrium just right on oil price. So so people just buy that as an oil price proxy, which I think it behaves that way, so it doesn't mean that it can't go up. When will be the up? How to retrieve it? So we will put the webinar on the PhillipCapital YouTube pretty fast, I think within 1 or 2 hours. Yeah, thanks for the question. The question on Tasin, sorry, I didn't answer it because I just wanted to double check. But the status right now for Tasin is pretty bleak, I mean, without stating the obvious. So the directors are issuing letter of notice of demand. In a nutshell, they just want their money back. So the banks are chasing them. Then the former shareholder, majority owner, claiming that there's some misgovernance and so forth. So it's in a the 2023 annual report is result is not out. 2022 annual report also not out. Yeah, so that's a that's a very bleak situation right now. I mean, without I think the obvious thing for Tasin. I'll hand it over to Mia to try and address that, the elite.
Hi, Paul. The question is, FY elite commercial rate cash flow statement in the repository. Can you explain what is adjustment and WC? This is working capital change. Yeah, so this is just a standard accounting procedure. Yeah, by taking net income on the income statement and then making adjustment to reflecting the change in working capital. Yeah, like receivable, payable, yeah, and some other non-cash item. Yeah, that's basically it. And can you explain FY23 income statement is a commercial rate as net income after taxes? Net income after taxes negative 22 million, but amount available to unit holder is 28.9 million. Sorry, let me pull up the report.
Is it revaluation loss?
A revaluation 22 point. Oh yeah, they have like a lot of adjustments, like what's it called? Unit in management fees payable in units. Yeah, so after adjustment, after this it become negative. Yeah, but for the distributable income, we'll just add back a lot of adjustments. Yeah, so become positive again. But it's just a non-cash item. It doesn't affect the income, net income. Yeah,
Yeah,
hopefully.
but I think the question is it's negative 22, then positive 29. So the big swing.
Yeah, it's because they deduct a lot of like non-cash item in the beginning, but they add it back in after adjustment.
Yeah. So I just want to confirm, is there a revaluation loss, right? Just to let
It's not
just to get a
revaluation
clearer
loss.
answer.
It's let me pull up. It's just among some like units payable. Let me pull up the financial statement.
40 million in units payable. Yeah, I think any you double check on it.
Okay.
But
I'll post in the chat group.
yeah, okay. Yeah, so sorry. Yeah, I knew we'll try to post it in the commentary. Should get back to you on our P3 community, because I know what the question is asking, because there's quite a big swing, right? Minus loss, then payable is, so there's almost like if you combine the two numbers, you're looking at almost a 50 million swing in the numbers. So yeah, we'll get back to you. Most probably it's a
So can I just add so that
yeah, sure. Derek,
I'm just looking at the income statement. Yeah, in the FY23 there was a 43 million pounds fair value of investment properties devaluation, the net change. So it's something like your impairment or revaluation loss like that. So that is a non-cash item. So in the income statement is you minus that 40 over million, but then because it's non-cash in nature for the distribution side, you have to add it back. Yeah, so
okay,
I hope that answers it. Yeah.
Thanks, Darren. I think that answers the question.
thanks.
So the main reason is that the net income had a loss because they had like what Darren said, there's a revaluation loss. So accounting wise, you got to take it in. But when you pay dividends, it's all virtually you pay from the cash. So that's why they got to take that out. Yeah. Of course, the tricky thing is always like what Miao mentioned was the dividends paid, the trustee fees paid in fees. So if the trustee, I think most of you know this, but just in case, if trustees want to boost dividend, then they collect in units. So there'll be more cash that can pay for dividends. Whether right or wrong, I mean, that's for everyone to debate. But that's one way you can boost it up. Because if you don't pay the trustee in cash, then they can pay more dividends to unit holders. Yeah. Okay, thanks. I hope that answers it. And thanks everyone for your questions. And if you have more questions, just go to a community and then post it there. We'll try to get back to you. With that, I'd like to thank everyone for your time. Wish you have a good day, although it's very warm today. But anyway, I hope everyone have a good day ahead. And thanks everyone for taking your time to attend this briefing. Thank you, everybody. The recording will be in our YouTube PhillipCapital channel. Thank you.